Well, good afternoon, everyone. Welcome. My name is Brooke Buchari, and I'm the Executive Director of Alumni Relations for the American College of Financial Services. It is my pleasure to welcome you to today's Alumni Association Knowledge and Network event. Today's program is brought to you free by the American College of Financial Services Alumni Association and our event sponsor, One America, who we'd especially like to thank for their incredible support. So without further ado, I'm pleased to introduce my colleague, Tony Boquet, who will be presenting today and who's going to start us off here with a poll question.
Hello, Brooke.
Hello, Tony. Welcome back again for another round here with our Alumni Association.
Yeah, how cool is this? Let's start with the poll question that's on the screen right now. Please answer this question to what you believe to be factual. What percentage of life insurance policies that need a life insurance trust actually have one created? If you could please reply to that, we'll get started. We have about 79% of you that think it's less than 50%. And if you be in that crowd, you would be correct. It is less than 50% over a 5-year period. That's one of the reasons why we're doing this session today. And I call it the heart of what we do, which is the settlement of proceeds. And, you know, I date myself because I've been in this business 37 years. And when I started in the life insurance business 37 years ago, settlement options were widely used, and people set up settlement of proceeds inside a life insurance contract. And that was very common 37 years ago. At least it was for the company that I worked for. And as time progressed, more and more people stopped using the settlement options, but they're in every life insurance contract issued in the United States. So we're going to be talking about how to use these effectively. But before I get into that, I want to give a little preface this by saying anything that I share with you today, please run it past your compliance department or your home offices before you try to institute any of this. Some companies have certain requirements. You be an estate planner, you have a certain credential. So I don't want you to believe just because you viewed this presentation that you have the go-ahead with your individual organizations. So please feel free to share this presentation with your compliance officers, with your training departments. They were also invited to participate in this, so some of you may indeed be in those positions. We're going to start to talk about the human life value and how that came about with the American College. One of the interesting things about our industry is back in 1927, when Solomon Huebner founded the American College, anyone could sell life insurance. You didn't need a license in most states. You could just start selling life insurance contracts. Back then, we even traded, the premiums were collected by the agents. So the people that were selling the contracts had access to all of the cash that was being collected. Scary, scary time for people with unscrupulous values to take advantage of people. Solomon Huebner was a rebel in his time because he thought the insurance industry should be viewed as a professional, as a profession, and everyone should be held to professional standards. The American College started what's called applied wisdom. Back when he started teaching the CLU, the education, the experience element, and the ethical components were all included in each of our courses. And to this day, we still do all three of those in every aspect of our course curricula. Solomon Huebner was the founder of the human life value. He believed that all human life, no matter what standard you had in or status you held in the community, you had a life value that could be determined and monetarily tracked. This human life value brought life insurance to a higher level and is still taught today in our CLU curricula, our chartered life insurance underwriter course. So it's very important that we deliver this content to you in a proper way. And that's one of the values that Solomon Huebner would be very proud we still carry forward today. I want you to look at this picture, and in your question and answer or your chat, feel free to reply what you see on this screen. Brooke, what do you see?
You know what I see. I told you what I see, Tony.
Yes,
I see the duck, and right away, the first comments coming in, a duck, a bird, duck first. And then there's some mixed answers here. So I have a feeling our attendees know what's coming here.
Yes, there we are. We have a rabbit. Just like this picture depends on your perception, a lot of times our clients see different things when they're dealing with us. When our clients are thinking about their proceeds and why they buy life insurance, what do they see? In your opinion, take a minute and answer one or more of these questions, and we can talk a little bit about that. It's been my experience after 37 years of doing this that many of our clients are not sure who will receive their proceeds. They set their proceeds in play through the beneficiary designation in a life insurance policy. But sometimes that person may not be the one that at the time of death should receive the benefit. I can't tell you the times that a divorcee, for instance, receives the proceeds of a life insurance policy just because the person didn't remember to change the beneficiary when they divorced. That happens quite a bit. And that's just an oversight in most cases. It's not intentional. Now, sometimes it is still best for that ex-spouse to receive the funds, especially if there's children concerned in the marriage. But sometimes it's just an oversight. So it behooves us as professionals in this business to make sure that we offer the right person these funds at the time of death. So let's stop here. I think we may have one or two questions that may have popped up.
No, I don't know so much, Tony, that we had any questions pop up yet, but someone did chime in and agree with you that often no, people don't know who the proceeds are going to, or they're not sure, you know, and it all plays into what you were just describing, you know, instances where people get busy and they forget to change things, or they don't have their checklists complete to run down and make those changes and make sure that they're having those conversations.
Yeah, very true. And part of what we do, and the heart of what we do, is make sure that that person is the correct person. So let's go ahead and start back with the slides. In essence, our professionalism calls for us to be held at an ethical commitment. We're making an ethical promise to every client that we serve. Every time that we sign our name on an insurance contract, we're making a promise that when that person passes away, those benefits will be paid to their beneficiary. That's a promise that doesn't end just because you retire, for instance. I've left my company, the original company that I started doing business with 37 years ago. They're still paying claims based on contracts that I put in play 37 years ago. So it doesn't end. My promise is still good to those folks still 37 years after the fact.
Right.
And it's very important as solutionaries, as people who solve problems for others, that we look to their best interests whenever we serve them. And staying in touch with the beneficiaries, staying in touch with the life insurance owners is critical to making sure that we do what we're supposed to do.
Right. There are definitely some people agreeing with you, especially in cases of divorce and and when they have to tell the new spouse that they're not the beneficiary and the old spouse is getting the proceeds.
Yeah. That's a conversation, Brooke, that's never fun, by the way.
Yeah.
It just isn't. So yeah, whenever the beneficiary is the wrong one, the one that you know deep down in your heart, that was not who was supposed to get the money. It's very difficult conversation to have. And sadly, we do have to have them sometimes. Let's talk a little bit about some LIM results. This is pretty interesting results. This LIMRA survey, I didn't put the date of the survey, but I want to say this was about 5 years ago. We did this survey through LIMRA. 63% of the people polled believed that they either needed a life insurance policy or were underinsured if they do, uninsured if they do. That's amazing. Over half the population, or half the people that replied here, said they knew that they needed more life insurance. 44% of millennials and 51% of Gen Xers believe the ideal financial plan would include life insurance. So a lot of times financial planners, you know, we teach that all financial planning should begin with a life insurance contract. All of the risk associated with insurance should be considered because, for instance, if a person becomes disabled and they don't have disability insurance, if they wanted to put away a certain dollar amount per month, they wouldn't be able to do that if they're disabled. Well, it's the same thing with life insurance. The goal would be for them to build their own wealth, but what happens if they don't make it to that age? Their beneficiaries still need those funds, and life insurance plays a big role in that. 40% would not be able to pay living expenses if the breadwinner died. That's a little scary because 40% of the people would have very little life insurance, if any, so that they could meet those needs, those basic needs that a breadwinner would need. And then 80% of the households surveyed admitted not having an agent. Now, I'm sure what they mean by that is they didn't have a relationship with an agent. 80% of the households in America, I'm sure, has some form of insurance. And most people have some form of life insurance, even if it is a small policy through their group insurance. But they may not consider that as an agent relationship with their provider.
Yeah, Tony, the first time I heard from anyone about life insurance, and I can speak as being that borderline millennial population, was from my agency that represented my husband and I for our house and our car insurance. And that was the first time anyone softly reached out to me and said, "Hey, have you ever considered a life insurance policy?"
Yeah, yeah. That's pretty interesting.
Yeah, yeah.
All right. What we're going to do now is we're going to talk about a case study. So, what I'd like you to do as we go through these slides, I'm going to breeze through them, but feel free to jot down any notes that you have, because I definitely would like to ask you some questions toward the end of this presentation. So I'd love your feedback. The case study is Johnny and Lucy Carolot and their family. Johnny and Lucy have two children, Skip and Susie, and they're 15 and 12 years old. Johnny earns about $200,000 a year as an attorney. Lucy works part-time at her church, and she brings in about $7,500 a year. By the way, this case study, the names have been changed, but this is a real case study. This is a real case that actually took place. When we did a needs analysis with this couple, their final expense needs, according to them, this was, of course, in an interview situation. And as all of you probably are aware, that when you sit into these interviews and you ask these people how much insurance they need, we have different techniques to draw this out. And in this situation, Johnny thought he needed $25,000, Lucy $25,000 for final expenses. Their mortgage was $860,000 at the time. They needed an income replacement of $800,000 on Johnny. Lucy opted out of any income replacement. She was, we did talk to Lucy about having some form of income replacement because she does so much for the children. She doesn't bring in a meaningful wage, but she does bring more to the table than zero. And we did our best to try to convince her otherwise, but they didn't bite into that. The education fund was $40,000 a child. So they want to set aside $80,000 per child for an education fund for these children. The totals are on the bottom: 1.7 million for Johnny, 965,000 for Lucy. This is the insurance in force, the life insurance in force. And as you can see, Johnny had one time his annual income, which is common in group insurance. We're making a sale today. So all you life insurance agents out there, congratulations, you made a sale to Johnny. He's going to purchase $1,350,000 from you today. He has a little $25,000 paid up policy. The name will be XYZ Insurance Company. And he has only $190,000 in 401k. So he needs a lot of financial planning advice. This gentleman is poised for you to take some action with him. Lucy had the $25,000 group insurance from Johnny, and she's purchasing $940,000 worth of coverage from you today. So you did pretty good. You sold some insurance today. That's pretty cool. Now let's talk about how we're going to set up the beneficiary, because we're going to do it a little differently than you may be familiar with. When we do a settlement of proceeds, we take into consideration how the money needs to be used. So for instance, the XYZ insurance on Johnny that's paid up, the $25,000, and the $25,000 Lucy has in group coverage will both be set. The beneficiary will be, for those policies, the spouse as primary beneficiary of one another. In the event that both spouses die together, Then the contingent beneficiary would be Lucy's sister, Pam. Pam will receive the funds because I don't know how many of you have lost insureds and the beneficiaries in the same accident. It's a terrible situation, but when it does happen, in most cases when it's husband and wife, someone in the family ends up arranging the funerals for both at the same time. That's the normal progression of this. So Pam would be responsible for setting up the funerals and handling any type of administration of the estate. And they would have to do this through a will, of course, if they don't have a life insurance trust. This is a good point, a good place for us to add as a caveat. This does not replace a life insurance trust and the need for a life insurance trust. In most cases, a case this size and with this much complexity, we would be best served, they would be best served by having a life insurance trust. That poll that we did earlier that said over 50% that need a trust never get the trust. There was some contention recently between a few different insurance companies that were saying that after a 5-year period, they tracked the people that they thought needed a trust and went back to them 5 years later and found out they still had not applied for the insurance trust, though the life insurance was in play and with limited beneficiary contentions. So that became a very scary thing for these companies. And they looked at using the settlement options and the settlement of proceeds again, just to bridge the gap until they get the life insurance trust. They can use this as kind of like a guide, if you will, to the trust indenture. And this model could be used in a trust. And of course, that's where we're going to direct them in the interview process. We would definitely want them to be the owners of a life insurance trust.
Tony, could I just share some of
Sure.
that's taking place right now? I know you're really getting into the heart of this here. No pun intended. But someone, Devin, had chimed in just when you were still showing the comparison between Lucy and her husband, that he said there would still need to be an income replacement for Lucy.
There should, yes.
Yes, yep. And then Mark had asked, did I miss the part of what type of policy or policies being sold, or how to structure the different policies to get to the coverage?
Excellent. We're not getting into which types of policies should be sold. This presentation is strictly on the settlement of the proceeds. How will the proceeds be distributed? And yes, some contracts, because of the accumulation of cash value, all of that could play into this as well. But for simplicity's sake, and just to explain the settlement options, we're not getting into which types of policies would be best, which percentages should be what. For instance, the XYZ insurance that's paid up on Johnny, that was a paid up policy. So that's a life policy, a whole life policy that's paid up. Lucy's group coverage is term insurance. So we're not getting into the discussion about which is best to use. We're just saying when you're planning the beneficiary and the distribution of these assets, what do you have to take into consideration? But that's an excellent question. And that would be another webinar, Brooke.
Sounds great. Yeah, just one other comment here that somebody was sharing for consideration. In divorce situations with children is another situation where a life insurance trust should be put into place.
Amen. Yes, without a doubt. Go ahead.
Oh, sorry. And then once you talk about that, another thing to think about is how quickly insurance proceeds are normally available to a person like Pam in this scenario to cover those final expenses. You know, I can speak fresh knowing how soon a funeral director wants the check to carry through with things. So just things for you to comment on here, Tony.
That's beautiful. That's beautiful. As to the payment, the time element of the claim, in these cases with the paid up policy, that would have to be an older policy. So it's going to be paid out a little quicker. It's a small face amount. Same thing with Lucy's group coverage. It's a small face amount. It's through group insurance. So it's usually not going to take a tremendous amount of time to get that paid. Most funeral homes will take an assignment against these policies. So there's always that ability to use the assignment process. That way the funeral does not, the funeral home doesn't bother the survivors wanting their money. They know their money's coming and they're usually fine with that. It's just they need to know that they do have the policy and that they will be getting their hands on it. Lucy's sister, Pam, this is a good referral for most of, you know, I try very hard when I was practicing to make sure that all of the family dealt with me. So I would be the one to explain to Pam what it means to be an administrator of an estate. What does it mean to handle a death claim? What does it mean? How do you go about it? So I would want an introduction to Pam, and this would be, again, another sale opportunity with Pam. So that's another reason why you want to be able to get these contingent beneficiaries and get as much information about them as possible. Now, one thing that I do want you to notice is that I put this, even though it's a small amount and even though it's going to be paid out to a funeral home, a big portion of it, I still put it under the interest option. What that does is in some states, the insurance companies do not have to pay interest on monies being paid out until the claim is settled. When you use a settlement option, the interest starts from the date of death. So by putting it under the settlement option, you automatically start earning interest from the date of death of the insured. By giving the person the right to commute, that means they have the right to take all of the money or some of the money out at their leisure. So Pam would be able to write a check or just tell the company, I need $40,000 for burial expenses. She would be able to do that and it wouldn't be tied up, but the interest would still be paid from the date of death. And that's important, not necessarily on this little $25,000 death claim, but it will matter on the $1.7 million or, you know, the $1.5 million that we're going to be holding for Johnny. That will make a difference. So a month difference can mean a lot of interest on that kind of money. Let's talk about Lucy's new life policy. You sold Lucy the $900, almost $1 million worth of life insurance. In this case, we put Johnny as the primary beneficiary under the interest option, settlement option 1, with the right to commute. He has an $860,000 mortgage. If he'd want to pay off that mortgage, he could. If he wants to take the money out and invest it somewhere, he could. He could do whatever he wants with the money, but interest would start accruing from the date of death on that lump sum. Now, Johnny's brother would be listed as contingent beneficiary because they wanted Johnny's brother, Ronnie, to pay off the house for the children. It was decided that Ronnie would raise the children, and Ronnie had a different housing situation. He was still renting. So they decided that if Lucy and Johnny died together, Johnny would move into the home with the two children, raise the children, and he would pay off the house with the $860,000 got from this settlement of proceeds. So again, we find ourselves getting another referral through Ronnie. Ronnie now is another person that you can talk to and explain, this is what Lucy and Johnny want you to do. Do you understand how to handle this? Do you understand their wishes? And again, this does not replace a trust. This does not replace the need of a will. All of those things still need to be in play, especially for the guardianship of the kids. You're going to want a will in place to make Ronnie the guardian, the legal guardian of Skip and Susie. So it's very important that you keep that in front of the people at all times. Any other questions or comments, Brooke, that we need to consider?
No, there was a question that you just answered for Susan. So we're good to keep going here, Tony.
Hey, Susan, good job. That was a great question. Okay, let's talk about Johnny's situation. Johnny has a 401k with 190,000. Now, there's a footnote to this slide that says special knowledge is needed for the handling of qualified assets. Johnny's 401k would be a qualified asset. So not everyone in this audience may be able to have that knowledge of what they need to do. So again, I'm going to preface this to say you need to check with your compliance department, with your training department for these kinds of things. You need to take the CLU course with the American College. That's going to be a fine place to find all of this stuff out. So you do need to have that education. He also has a group policy for 200,000. If you notice, I'm going to be the one changing the beneficiary on that group policy because I want to be their total advisor in their home when it comes to their life needs, their life insurance needs. So I will be the one filling out the form for them for that group life policy. You just have to ask them to get in touch with their human resource department and ask them for the beneficiary change form, and they can bring it to you. It's very simple to do. And the same goes for the 401k, as long as you have the knowledge you need to be able to do that right. And of course, they also have the life policy you sold them. So again, what we're going to do is we're going to put Lucy as the primary beneficiary. She gets the funds under the settlement option 1, so she gets interest from the date of death with the right to commute, meaning she can take all the money the day she gets it and she can take it all out. But this protects the money in lots of ways, and we'll talk about that a little later. But this does give her the right to commute. The contingent beneficiaries gets a little hard to follow, so please bear with me. And this is probably where you're going to have some questions. For the contingent beneficiary, we're going to list Skip, Susie, and their Uncle Ronnie, because they're going to be all 3 contingent beneficiaries. The interest option will be used for some of them will be the fixed amount option and the fixed period option. So different settlement options will be needed here. If the proceeds are payable prior to the kids reaching age 25, and that age was set by the couple, by the insureds, they're the ones that pick that age. They could say they don't get the money until 30, but they chose the age 25. If they die before the kids are 25 years old, a monthly income of $500 a child or $12,000 a year will be paid to Ronnie as guardian of the children. Ronnie will be getting $1,000 a month that he can use to help raise the children. $12,000 a year isn't a lot of money, but believe it or not, Uncle Sam says you can raise a child on half of that. You can raise a child on $4,500 per child. I raised 2 children and I can't see that. Brooke, I don't know, that was pretty low. So it was very interesting. You're muted, Brooke.
Yeah, I know. I'm muted here for a second. My husband and I were just having this conversation the other day and talking about, our kids all have 529 plans, and what college is going to be even like 20 years from now. And is it worth even still putting that money away if college is free or if the pricing structure changes? We don't really know. But one of the things, one of the audience members just contributed, Robert Duffy, said that, for this settlement of proceeds slide for Johnny, that he may not want to pay out $20,000 a year to the kids at ages 18 to 22, because it could, and I've seen this coming from a traditional higher ed background, it could affect their financial aid. So it might be better to save until that senior year and pay off the student loans upon graduation, and how great of an incentive that is for the kids. So really great conversations to have.
That is so true, and he's right on the money. He took it out of my notes. That's exactly what I would have said. So it's great to be talking to alumni of the college. They know this stuff. That's cool. So yes, they don't need to take the money at that time. This was just an option that they have, that they could take this $10,000 per child for 5 years. Now, the reason I go 5 years and never go 4 is because it's been my experience after 36 years of doing this, that if a child loses both parents before they reach 18 years old, very seldom do they take that money and use it for college the first year. The first year after high school, they usually blow the money. That's been my experience. So I always try to convince them to set aside, they don't have to take it, but they should set aside enough for 5 years of college if they're paying only for undergrad. Some people want to pay for the graduate too, the graduate school. That's totally fine. That is totally up to the client. That's the client's preference. In this discussion, the parents wanted only the bachelor's degree for each of their children that they were going to fund in specifically for college education.
Right. Well, and Tony, and some people are chiming in here, and it's true. The caregiver does receive over $1,500 per month in Social Security benefits for each child. And then a question too regarding financial aid. If the life proceeds are held in the settlement option, are they excluded from reportable assets?
That's awesome. As long as they didn't have constructive receipt. So in other words, if we give the child the ability to receive the funds, that's constructive receipt. Whether the child decides to take it or not, it's there for them. So when you give them the right to commute this, you're giving them the ability to take those funds. And the Uncle Sam says that's their money at that point. So that's a very good point. One of the things that I really appreciated about this family is their lump sum, the use of their lump sum. They gave the children $70,000 will be paid out on the child's 25th birthday. And the reason for that $70,000 was very interesting to me. This client, if you consider that at age 22, that child will not get another dime from these proceeds until their 25th birthday. The parents specifically said they want them to get a job. They want them to go to work. They don't want them to feel like, hey, they got this money and they don't need to get a job. So again, the parents are taking control. the parents have the ability to set the birthday. If they think one child is frivolous with their money, one child may be 35. One child, there's lots of different ways you can structure this. But again, the parents make that call. Usually it's the advisor is just giving them the kind of feedback that our participants are sharing about taxes, about Social Security, about those things. Those are all conversations that you're going to bring to the table to bring value to who you are as an advisor. In this case, the balance would be distributed at age 30. The child would get the entire assets. Again, if they want to invest the funds, of course, that's perfectly fine. We want them to do that. They would have a house free and clear, or Ronnie would. How Ronnie will handle that, that's again part of the discussions, but this is just to lay out the types of structures you can use with a beneficiary designation. It doesn't just have to be primary beneficiary, spouse, contingent beneficiary, children. It should be a little more thought out than that. Any other comments coming in, Brooke?
Just a great reminder that the Social Security survivor benefit is till age 18 and capped. And just, it's one of those things that people are not always aware of.
True.
Yeah.
That's so true.
Yeah.
Well, guys, before I get into this, I'm going to tell a little story here. So I'm going to stop sharing this screen for a second. I do want to share a story about a client of mine. And they were dear friends of mine. Similar situation to this settlement of proceeds. We did a life insurance trust for this family, but some of the funds were still handled in the exact same way that we just showed you. And what was kind of interesting was this was William and Susie, and they had one son named Billy. When they bought this insurance, and they had a little over $2 million worth of life insurance with us at the time. About 5 years after I sold it, William and Susie were in a car accident together, and they both passed away at the same time. Billy was raised by one of his aunts. Billy was 9 years old when we paid the death claim and started the proceeds to be distributed. At 18 years old, the company I was working with, we had a structure that if a claim was being paid, the agent of record was notified to see if you wanted to deliver the funds. So I was asked by the company, Billy's turning 18, he's going to be paid $10,000. Do you want to distribute those funds? Do you want to deliver it, or do you want us to mail it? Of course, I wrote back to the company, please send the check to me. I'll deliver it to his aunt and to Billy. So that's what I did. The check came in. I set an appointment with Billy's aunt, who, by the way, made great iced tea. She had the best iced tea. So I go to their home. I'm sitting in the dining room when Billy comes down the stairs. The last time I'd seen Billy, he was 9 years old. He was now 18. Boy, did he grow. He was a man. He reminded me of his father immediately. He looked just like William did. I mean, big, broad shoulders. He was a big kid. He had to be over 6 foot at 18 years old. So he was a big man. He sat down with me in the dining room. I explained to him the process for the money to be distributed for him to go to college. And I handed him the check for $10,000, saying his parents, not me, his parents set this up so that he could go to college. And this is his first payment. The young man looked at me, and he didn't look happy. He put the check back on the table and he said, I don't want that. I want all of the money that you're holding for me. I understand that from my aunt, she told me that there's some money you're holding. I know how much it is. I want the whole amount. And I thought for a while he may have been kidding because his father was a great joker. But no, he was very serious. And he says, I'm going to sue you. I said, son, you can sue me for $35. That's what it costs to start a lawsuit. I said, so yes, you can sue us, but you're not going to win that lawsuit. This is the way you're going to be paid, and there's nothing we can do about it. Nothing I can do about it, nothing you can do about it, nothing your aunt can do about it. It's done. You're going to get $18,000, $10,000 a year at 18 through 22 per your mother and father. They set this up, not me. He said, but you advised them. I said, yes, I did. But they did their own thing. They made this choice themselves. So I left that day. Billy was not happy. He took the check, stormed upstairs. His aunt was crying. I was crying. It was not a pretty sight. It was not pleasant. A year passes very, very fast when you're not looking forward to something. At 19, I get the same letter. Mr. Boquet, Billy's turning 19. We got a check for $10,000. Do you want to deliver it or do you want us to mail it? I had to pray on that because I didn't know what would be best. I didn't know if me going there would upset the family more because I knew his parents well, or should I mail it? I didn't know. And after some prayerful consideration, I decided to deliver the second check. This time when I called, Billy answered the phone. And I told Billy, I'd like to come out and deliver your next check. Would Tuesday at 6 be good? Wednesday at 7 be better? I know you work. How do you want to handle this? He set the date, set the time, and he was pleasant on the phone. He was okay. I get to the house. Billy answers the door. Come in, Mr. Boquet. He was very cordial, brought me into the dining room. Of course, his aunt was there. We hugged because she was a very good friend as well. And we sat down and I start my same discussion about the $10,000 from his parents for him to go to college. They would really like you to do this, and handed him the check. And he said, can I interrupt you? I said, yes, sir. He said, I was very rude last year. And he says, I'm sorry. He says, I didn't go to college last year with that money. I blew it. And he says, I feel bad about that. And he says, I promise you, I will use this money for college, just as my mother and father wanted. And he also said that his aunt, the money we were sending her, she never used on him. She kept it in a special account. So when he did blow the money, and I guess she continued, she was a very persistent woman. She kept on telling him, you need to go to school. So she paid the tuition the first year for him to go. And he told me this. And he said, I promise you, I will complete my education. Billy is now an adult, a grown man, children of his own. Billy changed because of his mother and father, not because of the money, but because the parents knew their children. The parents knew he would blow that money. They are the best people to make these choices. But we have to give them the opportunity to make those choices. We should know better than the client what are the options. We don't make these choices, they do. But you have to be intelligent enough and you have to be well trained enough to be able to do the right job for that family. Billy has more life insurance than his father today. And his kids are taken care of if something happens to him and his wife because of William and Susie. So each of you change people's lives every day. We hold ourselves as professionals, which means you have to be the one to make these hard discussions happen. It's not easy to talk about death. It's not easy to talk about things during these interviews. But the reward is great on the back end. And they deserve it. The beneficiaries deserve that. So take it upon yourself to look at these beneficiaries in a different way than you have in the past. I think you will be well served by that. And Brooke, I'm sorry I got emotional. I said I wouldn't do that, but just couldn't help it.
What a powerful, impactful story that has stuck with you for so many years. And it just really speaks to how important the work is that you and everyone else here attending are doing. I mean, our president here at the college says it all the time. We're changing people's lives. And that's exactly what you did there for Billy. So thank you for sharing. And I think I speak for everyone there in thanking you for sharing.
Well, if you would, let's take a minute and look at these questions. I know we're running out of time. We only have 4 minutes left, so we're rushing.
Yeah. Well, Tony, oh, sorry, Tony, really quick though. Someone had asked a question that just as you began sharing the story, I wasn't able to jump in and ask you, but just playing off that too, under that settlement option, can the guardian or children access those funds for emergency costs like medical or things like that?
Depends on how it's structured. Anytime it's with right to commute, yes, they can. And even if it isn't with the right to commute, they can petition the courts to use the funds for emergencies.
Okay.
Sometimes, that's that's part of the tough discussions, because I can tell you times when the beneficiary was an alcoholic, mm-hmm. and or a drug abuser or had other issues, and the parents or the spouses know these things, and they may not be quick to bring it to your attention. That's why the relationship is so important with an agent. When I see those statistics that say 80% of the people don't have an agent, that means they're not talking to the right people. They don't have a trust relationship that they can be honest and trust the person that they're talking to. So those are very tough discussions. And I don't know if you want to go over the time, because we're going to be running into a crunch situation. But there's so much here. What you're seeing on the screen, these are things that you have to consider and talk about with your client. The spendthrift clause, that's what we were talking about, where if the person's an alcoholic or if the person has debt problems, you don't want them getting lump sum money, because then the debtor can attach those proceeds. So it's very important that you know what the situation is with these beneficiaries. The survivorship clause comes into play if both are killed in the same accident. A person can die from the same accident 60 days after the primary insured. If you don't have a 60-day survivorship clause, then the second beneficiary will not get the money. And all of this is for nothing. So you have to make sure that you're doing the right things to make sure that all of these people get the funds they need when they need it. And I'm sorry we're having to cut this short because this was very important material. Any questions?
Tony, there was a question, amongst the support for you and sharing and being a true human being and professional, but someone did ask about the language and all in the beneficiary statement of contract, or is it in a trust? If the language is in the contract, have any of your companies balked at the language?
That's why I prefaced this whole conversation with, you have to get with your companies to see if they have special settlement of proceed language that they put into the contract. When they have those, it's an addendum to the life insurance contract that most companies have what's called a settlement of proceeds form that they fill out. And it gives the advisor the parameters for that individual company, because every company will be different.
Right.
So you have to know your company, you have to get with your company on those things.
Sure.
But that's a great question.
Yeah. Well, Tony, I think it's a great reminder and a great way to end this, to remind everyone to check back with their organizations and their compliance offices, and great practical advice to use in practice. And if anyone is looking to reach out to Tony and wants to talk more, or someone was also interested more in the LIMRA survey in terms of details about the household ranges, I'm sure they can reach out to you, correct, Tony?
They can. They can also go to LIMRA's. I think I got that off the LIMRA site. So LIMRA's site is open, and yeah, it's easily obtained.
Well, wonderful. Well, I just want to, on behalf of the American College Alumni Association, thank everyone again for attending today's presentation. We welcome your feedback from this event, and we're so glad you could join us. Thank you again, and have a wonderful afternoon.
Thank you all.